Go through the price targets now for year end and for next year, and we'll take it from there. What are you looking for at the moment?
Yeah, so we have gold rising another 10% to 4,300 by the end of next year, but with significant upside, both because the recent drivers of the rally are driven by the pretty sticky inflows from both central banks and ETF holdings. It's not driven by spec positioning, which tends to be more mean reverting. And second, in September, we saw that ETF inflows were 6 times larger than what our rates-based model predicts, suggesting that private sector diversification into this relatively small market, and the gold market is about 70 times smaller than the US Treasury market, that this is causing potential significant additional upsides to our already above the forwards and above consensus target.
So let's try and separate those individual drivers. Let's go for the first of all, and then we'll get to the second and third point later. The central bank diversification has been a story that's been building now for a number of years, and we've seen that in the performance of gold. Why do you think that story is not just a one-off diversification, that you actually believe that's an ongoing trend, something that could persist?
Yes, so we think that EM central banks remain underweight gold. We think that the freezing of Russia's central bank's reserves in 2022 was a significant wake-up call, with reserve managers in central banks realizing that the truly only safe asset, if you hold it in your domestic vaults, is gold. We estimate that, for instance, the Chinese central bank has about 8% of its reserves in gold. The global average is 20%. That's also where Russia went by 2022. If you look at central bank surveys of gold purchase intentions, they are at a record high. So we think central banks remain underweight gold. We estimate that you probably have another roughly 3 years of very rapid purchases that have been 5 times faster since 22 than the pre-2022 average. So that is really the main structural driver of our bullish gold call. Cyclically, with 100 basis points of additional Fed cuts, you get an additional boost, because ETF holdings tend to rise in the gold markets when rates come down.